Hello, and thank you for taking the time to learn more about your family bank. There are 7 steps to this presentation, but today I'm only going to go over 3 of them for you. I have a couple of questions for you. Are you 100% sure you're going to have a great retirement, or do you have some doubt? Well, what if I can show you how to get out of debt in 9 years or less, including your mortgage, without spending any additional money than you're currently spending right now? You see, the average American household has household debt of about $250,000. That's one of the main reasons why a lot of Americans are not 100% sure that they're going to have a great retirement. Another reason is because of the taxation that we have in America today. If you look at this pie chart, you can see that 34% of is going out towards interest, which is the credit card loans, student loans, mortgage loans, all the interest that is being paid out today for Americans. 34% of every dollar is going out towards that. That 40% is going out in taxation. And that's not just talking about your income tax. That's talking about the cable bill tax, gas tax, any kind of tax that you may think you didn't even realize that there was a tax on that particular item. Well, that leaves 23% for lifestyle and 3% just for savings. And I can tell you today, folks, that is not the American dream. Well, with the Your Family Bank approach, we show you how to reduce the amount of interest that you're paying out by reducing the amount of debt that you have. We show you how to reduce the amount of money that you have susceptible to taxation, thereby increasing your lifestyle money and the money that you have available for savings. So let's talk about step 1, which is knowledge. Knowledge becomes power only when you decide to put it to use for yourself. We're going to give you an example here of a family that took advantage of the Your Family Bank system. But please remember that it only will affect your situation if you decide to do something about it for yourself. Let's look at the game of life and the average American as we go through life. We accumulate debt, we buy cars, we pay for college, and most times we're spending loans on those colleges. Then we go out and buy more cars, we buy houses, only to repeat this process and get in more debt, which includes vacations and more debt. By the end of this process, we know that the average American has $2 million of lifetime income, and they arrive at retirement with $60,000. There's only $60,000 total assets at age 65. So if you look at that, that's 3% that goes towards savings, 34% going towards debt, 40% in taxation, leaving 23% for lifestyle expenses. So what if I could teach you how to reduce the volume of interest you're paying to lenders, get out of debt in 9 years or less, increase your income, decrease your taxes, save for college, and retire with a tax-favored income? Step 2 is cash flow. When you track your money, you control it. We know that cash flow is very important for both families and for businesses. So what we show you to do is to look for ways to save money and be more efficient. We have a spending planner worksheet that we can share with you. And on this spending planner worksheet, it shows you to just basically track your last 12 months of how you spent money, your next 12 months of how you spend your money, both fixed and variable expenses. But as you're looking at your savings, we want you to plan for the unexpected as well as the expected by using the 80-20 rule. 80% goes into long-term savings, and 20% is going to go towards emergency and emotional spending. Let's talk about that for a second. Emotional spending. We know that we all do it. Have you ever seen that person that goes to the mall and says, hey, that's on sale today, I think I want to buy that? Well, that's an emotional spend. Or that golfer who says, I've got to buy that driver because it's going to improve my score by about 10 points. That's an emotional spend. Well, we all do it. So we just say, why not plan for it? So when you're doing your savings portion on that form, or if you're just thinking about your savings in general, 80% towards long-term, 20% towards emergency and emotional spending. Let's talk about the banking system and how you can leverage your cash flow. You put money into the bank, basically $1, they're going to give you back 1%. And they turn your dollar around 10 times in order to loan that out to others to get back interest on personal loans, car loans, mortgages, credit cards. So basically your dollar turns into $10. So you get the 1% while the banks earn 45%. So what we show you with your family bank is how you can flip this process and you can become the banker for yourself and earn that 45+% when you understand how the banking system actually works. Step 3 is debt. Minimize your debt to create additional wealth. Now let's look at a typical American family, Mark and Joyce. Here's their financial worksheet. They're 37 and 35 years old. They have 3 children, aged 3, 4, and 8. The monthly income between the two of them is about $7,000. They have an IRA, which is less than $100,000. Their main areas of interest was increasing retirement income, reducing debt, getting spending under control, increasing their savings, college planning, and doing a will and trust. If you look at their savings and investments, they have a Bank of America emergency fund at $6,000, earning 1/4%. They have a Fidelity account of 401k at $36,500, putting in $300 a month, earning about 5% on that. Their outstanding debts have a Visa, medical and dental, Discover credit card, furniture bill, auto loan, a mortgage. Total debt, their average interest paying out is about 10%. Their balance, when you asked them about that, they said it was $179,352. And the amount of payments that they had going out of their pocket every month was $2,177. It's not unlike most people that we talk to today. So let's look at Mark and Joyce's real debt situation. They're at 29.5 total number of years to get out of debt. $179,352 of debt balance, $194,988 in interest paid if they continue to make those payments over that period of time. That's a real debt situation of over $374,000. Absolutely amazing when you look at those numbers like that. Their current retirement planning without your family bank, you're at $36,500 of current retirement savings, $300 monthly contribution, 5% annual interest rate, 25% income tax bracket. The retirement account at the end of the savings period of 30 years, they would have $408,890 before taxes, but after taxes, it would reduce to $306,668. So let's look at what Mark and Joyce were able to do with your family bank. They were free from lenders in 7.9 years. They saved $116,743 in interest. They freed up $2,177 a month for retirement. And if they continued to make that monthly payment into their retirement, they would have a savings balance of over $1 million. That is absolutely amazing when you look at that situation. Their current plan, if you look at their two plans together, they're at $306,668 after taxes for retirement. With the Your Family Bank system, they were over $1.1 million in a tax-favored retirement system for themselves. I'm telling you right now, anybody who is looking at this situation, you should be very excited that you've looked this far at this situation and know that you can do this for yourselves as well. So what is the cost to Mark and Joyce for not doing Your Family Bank? They would have lost over $1.1 million in retirement and $116,000 plus in interest saved. That's a total cost of not to do this system of over $1.2 million. Now, if you'd like to know more about how Your Family Bank can help you, just like it did for the Mark and Joyce situation, I want you to fill out this form below, and someone will contact you to go through more of this presentation for you and give you exactly how this can work for you and your family or business. Thank you.